Everybody, and welcome back once again to the MD Investor Podcast. I am your host, Dr. Butler, and today this is going to be a continuation of what we discussed in the last episode, which was the 6 core principles. So just to recap, again, before we get started, if you do like the content, it is something that you do find helpful or interesting. If you have questions or if you want to have place comments below so that I can get some feedback on what you think, I'd greatly appreciate it. So don't forget to like and subscribe and hit the little bell button below. This will give me an indication that you actually enjoy the content, so that way I can actually try to make adjustments to what's helpful for people and what actually helps to get the message across. So let's go ahead and continue. Like I was saying, we have the 6 core principles, and just to recap what we discussed before, we have your earnings, which is what's going to be coming into your bank account or into your possession from what you're doing for work. So again, if you work as a physician or you work as a nurse practitioner or a PA or a police officer or a firefighter or anything of that nature, or maybe you're a lawyer, if you're in this kind of career space so where you're a little bit of a more solidified career and you're able to bring in money, we want to talk about how you're moving that money around. So however you're bringing money in, everything that you're earning is going to be in that first core principle, which is the earning principle. Everything that's going out is going to be in that spending category. So the second core principle is spending. So between the first two is how you actually start to create your budget to know what you actually have, how to build more, whether or not you have a deficit or whether or not you have some surplus. So if you have a little bit more than what you're actually spending, and if you have a certain budget to sit with and fix yourself on, that is always the best option. So in this case, again, like I was saying before with the 50-30-20 rule, 50% of all of your living expenses should be 50% of what you're bringing in. So again, if you're living off of, let's say if you're making $200,000 a year, you should not be living off of more than $100,000 a year. So that means you shouldn't be living in a house that costs, $4,000 a month if you have a $200,000 a year salary. And the reason is because if you start to do the math on having a $4,000 a month mortgage plus all of the expenses, the upkeep, your groceries, your electric, your insurance, whatever it may be, once that starts to hit over 50%, then you start having a very tight budget and it makes it difficult. So what we want to do is have where all of your fixed expenses are less than 50% of what you're bringing in. Then we want to talk about having an amount of fun or enjoyment. You want to enjoy life, but that should be limited to about 30% or less. 30% is pretty reasonable, I think. It might be higher for some people or lower for other people, but 30% is a really good round number. And in this case, that's going to be your leisure. That's you going on vacations, going out to eat, going shopping, or buying new clothes or buying new things of that nature. That's stuff that you're going to enjoy doing. And then 20%, I feel like, is the bare minimum. That should be the bare minimum that you're saving. So again, if you're making $200,000 a year, $20,000 should be going to your savings account in some form or fashion. So if that savings is investing, or if it's going into a business formation, or if it's going to something that's going to prepare for your future or your retirement account, or maybe you split it, maybe it's 20%, 10% goes to investing, 10% is going to go towards maybe your savings or your retirement account. It just has to be, you have to be paying yourself for the future, okay? So when you're working for a job, you're paying for your living. That does not pay you, okay? You have to understand the difference. So whenever you're working, you're paying for your living and your lifestyle. That doesn't pay you. You have to pay yourself as well, because if you do not do that, you will be broke in the future. So just make sure that you always pay yourself as well. In this case, we already discussed those principles, and then we moved on to borrowing. Saving. Saving is the third principle, and saving, again, there's only 2 real categories that we focused on, which is emergency funds. 2 to 3 months of your living expenses should be in an emergency fund. That fund should never be touched unless, you guessed it, it's an emergency. If it's not an emergency, do not touch the fund. And once you hit 2 or 3 months, then just leave it alone. So you don't have to go back and forth and keep adding to it. No, once that is full, it's like having a full tank. Just leave the tank there and only go to it if you have emergencies. You're not supposed to pull it out for, oh, you saw this really nice bag that's on sale, and then all of a sudden you're like, you know what? I have it in my emergency account. Let me just buy the bag and I'll replace it later. That's a no-no, because one is you're breaking your own financial rules, and once you start breaking the rules, it continues to be easier to break the rules, and then all of a sudden all the rules go out the window, and then now you're not following a system. And if you're not following a system, it means you're not doing anything but spending when you feel like it. And if that's the case, you're going to continue to be stuck. So we want to follow a system that makes sense and that's easy to follow because it has strict rules in place and you follow those rules. The next step we're talking about is within the saving category is saving for short-term goals. So if you're saving for a vacation, or if you're saving for a new car or a new home, then you're going to continue to add to this pot on a monthly basis until you reach your goal. Now, rushing your goals or skipping your goals is how people end up into pitfalls, so where they're stuck in debt, and that debt leads them to sacrificing your life for paying off debt. And a lot of times that's what happens. So the more educated you are, the more debt you create. The more debt you create, the more you're obligated to work. The more obligated you are to work, the less you're going to enjoy your lifestyle. And the less you enjoy your lifestyle is why doctors fall into the category of being depressed, being the ones who have a lot of substance abuse issues, being the ones who have a lot of issues with divorce and things of that nature. Why? Because you're obligated to work in order to keep up with the lifestyle. That one is, you try to create a lifestyle while you're still fixing the issues with your finances. And if you create a lifestyle that's too high or a lifestyle that happens too quickly, then all of a sudden you're stuck. And a lot of doctors don't feel like that lifestyle came too quickly. And the reason is because being a doctor takes a long time. So if you spent 10, 12, 20 years all together in your education cycle, by the time you actually become a physician, you're like, I deserve this house, I deserve this car, I've been working for forever, it's my time. And jumping the gun just a little bit can put you in this financial trap, and once you're trapped, it's very hard to dig yourself out of. Okay, so this is why I'm trying to help give this information out there, especially to new attendings. Before you end up falling into that pitfall, before you end up falling down those stairs, I want to make sure that you realize what you're getting into. So those are the aspects of saving. Borrowing. Well, we got a lot heavier into borrowing because, again, borrowing is something where debt can be created and it can be a disaster, or wealth can be created. And if wealth is created, it's because you're using borrowing for leverage. And those leverage is what you're using to get other people's money to purchase you assets and then have other people pay those assets off. So again, if you're getting into real estate, then other people are paying you for the real estate. They're paying the mortgage for you. They're paying the bills for you. So even if it takes 30 years, after 30 years, what happens is you have a debt-free property, and that property is going to continue to cash flow. And all you have to do is work on maintenance. And then from a tax standpoint, the government sees property as a depreciating asset, not an appreciating asset. So even if the price of real estate goes up over time, you can always write off the expenses as a depreciating asset. Same thing with vehicles, same thing with trucks. They have like a 5-year depreciation, and you can actually write that off over time or all at once. It really depends on how good your accountant is and how good your tax structure and systems are set up. And if they're set up properly, they will be saving you money, a significant amount actually. Next, we're going to talk about the two principles that I really wanted to get into, which was investing and protecting. These are where you actually create wealth, buy your time freedom back, and actually save your wealth so you can pass it on to the next generation. So again, as the MD investor, I am heavily invested in the investing aspect. And when I talk about investing, for myself, everything is an investment. Literally any and everything can be an investment. I don't care if you buy a pack of water. If you can sell the pack of water for more than what you bought it for, then you made an investment and got a return on your investment. So the idea of investing means that you have to have the mindset of understanding when an investment is actually an investment. And most people think that, oh, I just bought stocks, that's my investment. That's not how it works. An investment works by, I guess the key cliche principle is buy low, sell high, which is true. That will never fail. But timing your entry, not timing the market, timing your entry is where you actually make profit. Profit is always made on the purchase, not on the sale. And a lot of times this is what confuses people. So let's say stocks, for example, if stocks like AMD, if AMD is $100 and you bought it at $100 and it runs up to $105, then your entry was fine. However, if you bought it at $100 and it drops down to $75, then your entry was terrible. So it's not an investment, it is a loss of money, and a loss of money will always be an issue. What we're talking about is the difference between when you entered. So if you understand how markets work, everything works in a cycle. So you have peaks, you have valleys, you have peaks, you have valleys, you have upward cycles, downward cycles. So when things are cycling, if the market for real estate is on a downward cycle, then in this case, this is when you want to be a buyer in that market. If stocks are on a downward cycle, this is when you want to be a buyer in that market. You want to have the best entry possible, not because everyone likes it and everyone loves it. That is when you will struggle. So not when everyone likes it and loves it, that's when the struggle happens. But you want to do it when everyone hates it and they're terrified of it. So if everyone is running away from the stock market, if everyone is looking at this now, at this current point in time, cryptocurrency is falling into the ground. Like literally Ethereum was up to like almost $5,000. Now it's down to like $900. This is when I will buy more Ethereum. This is when I will buy more Bitcoin. This is when I will buy more cryptocurrency in general, because everyone is running away from it. And when people hate it and when it's bleeding, that's when I want to be a buyer, because it's about entry. And entry is what leads to success, because I make money off my purchase on entry, not when I'm selling it. So again, if Bitcoin now is under $18,000 and I go to heavily buy Bitcoin, when Bitcoin hits $50,000 and I sell one coin and it's going to give me my entire reimbursement back from my first investment, that is a return on my investment that I'm interested in. And again, I will make the same kind of cycles over and over and over again in order to make sure that I am cash flowing properly. Sometimes these cycles take years. Sometimes these cycles happen very quickly. It really depends. You just have to be true to that whole investment process, and it will be something that you will always see a benefit to. Now, the next step in investing is understanding that the mindset of being an investor versus being a trader versus being someone who is just interested in investing but not really sure where to start. So again, everything is an investment, everything in life. So everything has to have a return to it. You chose a career and you get a return on that investment. So for example, if you went to college and you were a liberal arts major, and from that liberal arts major job you weren't able to find a career in your field that was worth it, and that is a poor investment, unfortunately. And it's not like a shot at anyone or anything of that nature. It's just how investments work. The point of an investment is to have a return on that investment. So in this case, college is not a great return on investment for everyone. It is a great return on investment for a certain amount of careers. So let's say if you're an engineer and the return that you can get on that investment is phenomenal, then great. Being an engineer is something that's good. You might hear my young ones in the background. So if you hear some loud random noises, I apologize. But again, that is something that's there. Okay, so where were we? In this case, when you're investing, you want to make sure that getting a return on your investment is something that's going to be a top priority. It's not always going to be very easy to discover. For example, you don't know that going to college might not be the investment for you. Maybe you're more of an entrepreneur. Maybe you have an entrepreneur spirit and you want to actually focus more on business. But it really does depend. So in this case, you have to map it out. So if you're younger, if you're in high school, think about what you want in life and then map that out. Because without a plan, without a goal, without a purpose to whatever you're doing or whatever you're investing in, then you're guessing. And then once you guess, maybe it works out, maybe it doesn't. But sometimes that's how it works. And then that failure that you have from not figuring it out the first time around is also what helps lead you to success. So again, even being a physician, I was under the impression that when I was a child, that physicians were wealthy. So I thought that once I became a physician, I would automatically be wealthy. So that's coming from an aspect of a child's point of view and not necessarily what the real world is. Being a physician is complicated. There's a lot of aspects to it. There's a lot of upkeep. There's taking your boards. There's doing a DEA. There's making sure your license is up to date. There's getting licenses in other states. If you travel a lot, like locums and things like that, then you're going to have licenses in different locations, and it's going to be a pricey experience. However, that investment is always going to give you a good return because being a physician is a very high paying career. Now, for example, most people would never take that same investment in time if the return on that investment was terrible. So let's say it took you 12 years to become a middle school teacher or to become a PE teacher, and it cost you $400,000 or $300,000 to get your education to get a job that's going to pay you $40,000 or $50,000 a year. You would be like, why would I do that? You'd be upside down for life. It doesn't make sense to do that type of career. And that's what I mean, is that your return on investment has to be worth it. So being a physician is a decent return on your investment, or being an engineer, or being a lawyer, or being someone who's going to be able to make 5 to 10 times what their initial investment is over the course of your lifetime. That's going to be a good investment. So you have to think about that when making that approach. The same thing is going to happen when you're investing in different fields. So for myself, I focus on multiple streams of income because I want to make sure that no matter what happens to me, rain, sleet, snow, injury, whatever it may be, I want to be able to have money coming in whether I work or not. So I did not know what aspect let's put it like this. I didn't know what to invest in initially, so I tried various things, from e-commerce to government contracting to trucks to real estate to home goods. Whatever it was, I invested in it. But the first and the main component of investing is to make sure that you invest in yourself. If you do not invest in yourself, you can't grow. And if you can't grow, then essentially you die. It's just like plants, right? Everything is growing in life. You have to keep moving. You have to keep momentum going. Because if you don't do those things, then you can't grow, you can't expand, you can't build. So you have to take the step to say, hey, I'm interested in real estate. What's the next step? What's the next step? I'm ready to do this. What's the next step? Do I need this kind of money? Do I need this kind of property? Does it need to be in my state? You have to do some type of research, just like we do with medicine. It has to be evidence-based. And once you have the evidence, once you have the proof, then you can start going in, which is why I try my best to help people understand how to invest. It doesn't mean that you're going to be a millionaire overnight. It just means that you have to take that initial step. And I took those steps, and sometimes I took the steps blindly, but in this case, I learned from those failures and I learned how to step correctly. All roads that lead to success have to go through failures, because the failures are going to show you the pitfall. Kind of reminds me of that show like Squid Games, right? Like when they're crossing the mirrors or the windows or whatever that bridge is made of glass. Every single failure where people have fallen into that trap and were defeated, right, shows you which road is correct. So eventually, if you keep breaking all of this glass, it will show you what steps to take. So I've broken a lot of glass when I was trying to invest, but I've also found out which steps were strong, which steps lead me to success. And then I can keep taking those steps back and forth. And then if you know which steps are safe, you can always back and forth on that bridge all day, right? It's irrelevant at that point in time. Now the next step is, once you find a successful avenue in terms of investing and starting to create wealth, then you have to protect it. Protection is the key, because making money is not as hard as you think it is, but keeping it is significantly harder. Why? Because there are things in place meant to take wealth from you. There are a lot of things that people do not consider, things that have to implicate your family in major ways without you actually considering it. So that has to do with things like taxes. Taxes will always be something that's going to destroy your wealth over time. You're going to continue to pay someone else, the government, over time, whatever you're allocating to them. So if you structure yourself properly, you understand how a business should be formed, then you will understand where money is going, and you can alleviate, through legal loopholes, taxes. Now you also have to understand how to bank for yourself. So banking is something that's like, you're going to borrow something, an aspect of of whatever it is, right? You want to borrow for your education, or you want to borrow for a home, or you want to borrow for a car. Now, what if you can eliminate all of that and you can have your own banking system for your family? So, for example, if my child wants a car, they don't have to go to a bank or get a lender or have their credit pulled or anything of that nature. I can cover that fully, and then they can pay me back. Right? Does that make sense? And I'm not going to destroy their credit or have them have ridiculous interest, but they'll still get the benefit of understanding how a structured payment should happen and how a system should happen. It makes more sense that way. And you can do these things with life insurance. Life insurance can help. There's different types of life insurance. There's whole life insurance. There's cash value life insurance. There's all kinds of ways to help try to protect your wealth. And then you want to protect your wealth from when it takes place from death. Okay, so what I mean by that is when you die, there are things that are taxable and non-taxable, and there are certain value assets that can be taxed to collect for debt. So if you die and you still owe money on your house, now all of a sudden the home that your family's built together gets taken away. Why? Because you borrowed that money from someone else. Now imagine if you didn't have to borrow that money, you had your own banking system. Now your home is protected, your vehicles are protected. For a lot of states, $400,000 is the limit for an estate to be taxed, which means that it's very easy to go over that amount. So if you have a home and you have two vehicles, you're already over $400,000. It could be very simple, depending on where that home is. If you live in California, you live in New York, your home can be easily taken. And why that can happen is because the value of taxes happens when you die. So in terms of a probate, for example. So if you guys don't know what a probate is, when you die, your assets are counted up and then divided amongst your family, or however you see fit to do in your will or whatever it may be. And the government is going to tax the value of those assets at an appreciated value. So this is how a lot of people lose their wealth. So for example, let's say your grandfather or your great-great-grandfather bought a home in 1960. It is now, so let's say he bought a home in 1960 in Brooklyn, New York, and he paid $200,000 when he bought the home. Now it's worth $6 million. You imagine passing that on to your child, and your child has to pay the value of that home's in taxes, like the taxes from that? It's impossible. So then what happens? Now that home gets sold. So now someone else is going to take over the value that was brought into your family. So like the generational wealth of owning a home in prime location is now taken away from you. And people lose their wealth like this all the time. Like someone's grandmother dies and all of a sudden that house has to be sold. Why? Because there are a lot of rules in place. You cannot pass a home on to more than one offspring. A lot of people don't know that. So depending on the state, you can't do that. So in California is a state like that. So for example, I have two brothers. So that's three of us. So if something was to happen to my mom and she's like, hey, I want to leave the house to you three, she cannot do that. She has to pick one person. And if she picks one person, she says, hey, Tyrone, you're the oldest, you take the house. Okay, what do you think is going to happen? Now me and my brothers are arguing because they're like, that's not fair. She's my mom too. This happens all the time. So I'm creating a fake scenario, but in this case, this happens all the time. So what happens instead? Now that property, which has a net worth, which has equity in it, gets sold. It gets sold to cover the probate. It gets sold to cover the fact that you and your family members are fighting over it. And now those assets are deviated up into cash. And then cash ends up doing what? Being spent. And once it's spent, it means your net worth is decreased. So now you didn't protect it. Now things like trusts are able to pass on asset from one class to another, generation to generation, without it actually ever being taxed. And the reason that is because the trust owns the asset, not the person. And a trust can stay in place as long as the trustee always remembers to update these things. So now if that same home is owned by a trust, when the trustee of that company, or asset passes away, they just have another trustee in place. And now all of a sudden it doesn't go through probate, that property doesn't get lost, generational wealth doesn't get destroyed. This happens over and over and over again, and you can think about families who've made this mistake on a massive scale. You can think about the Vanderbilts, right? So the Vanderbilts used to be worth billions, and that wealth has been destroyed because of sudden death happening, and then all of a sudden these things aren't put in place, trusts aren't put in place, the family ends up fighting, and then all of a sudden all the wealth is dispersed amongst the family, or it's split up in taxes and it gets destroyed. And we want to avoid that. So protection is always going to be key. It's going to be the final step in making sure that your wealth gets to stay your wealth. We did go a little bit longer, but I'm really hoping that this information is something that is helpful. I'd love to talk more about it and then give more information about it. But I also want to make sure that you guys also enjoy the information. So again, don't forget to like and subscribe if this has been helpful for you. And always, I am wishing you guys wealth, health, and happiness, and I'll see you next week.